Guys, Logan here again with Halcyon Trader today, and we're going to answer you guys' questions from the last video. Now, we picked 5 questions specifically, or right around there, for ones that we really wanted to touch on, and we kind of have this set up to where the video should go pretty well from the start to the end of a trade, just to help you guys out. So thanks for joining me again, man.
You have got it. No problem at all. I'm glad we've got some people interested in seeing how to use some of this calendar spread for some weekly income or otherwise. And as you mentioned, I think what we'll do is work our way all the way from how to create it down to how do we defend it, and sort of everything that you would normally come across that's in between this. I will say we'll use it from the idea that you're in the perfect environment for this, and that everything is as is, because who knows, when somebody watched this at a different time from where we are right now, that the VIX is totally different, and thus it might not be the same way you would set it up. So sounds good. So start with creating. Is that maybe the best way to go?
Yeah, let's launch with the creating. I like that.
Sweet. So I know you have some questions on how do you create these, and then usually what's tied in with that, especially if you're someone who's coming from the credit spread land, where you're usually doing put credit spreads or doing some call credit spreads. Normally the question is, what kind of deltas should I look at when I'm creating a calendar spread? Because obviously in the credit spread world, that's really important to know what your delta is that you're taking on, whether that's a 20 delta or a 70 delta, right? The odds are very different from one to the other on the credit spread land. One of the reasons that I really like the calendar spread in certain environments and use it as a tool, as a piece of your arsenal for trying to get money out of the markets, is because some of that factor with the exact perfect delta isn't exactly my main focus when I'm creating these. So I'm just going to kind of walk through my thought process at the very beginning, what I'm looking for, and then how you can tweak and adjust before you hit that confirm and send button. We'll also kind of walk through how do you literally put the order in. I'll do that on Toss. I can't speak for other platforms like Robinhood or Tasty or something else, but on ThinkorSwim, we'll walk through how you do it. The days to expiration, what I'm typically looking at, the normal ones. There's always exceptions. There's always different reasons to go longer or shorter, depending on what your strategies that you're looking at. Then we'll get into the kind of how much money, typically, how much do I allocate per trade? A little bit of a variable, but I do have sort of a general rule around that. And then finally, how do you defend these? And on occasion you do. And I would say be on the lookout for a video later on this that Logan and I will do, where we actually are walking through a live trade from start to finish, from when the start to finish of it, that had a lot of defending moves involved. It was honestly a pain in the butt trade, but we're going to see how this finishes up by the end of this week. So, but it's a good learning experience, right? You should learn more from your losses than you should from your wins
100%.
in trading early on. They should teach you about a lot of things with what your setup was, to what the environment is to be able to be profitable, et cetera, et cetera. So we'll get into that later on. So
100%.
Let's start with the creating side of it. What am I looking for? First and foremost is I want to know, what is my VIX doing? Because remember, folks, that when you're trading options, and then specifically on the SPX or the SPY, you need to know what is your VIX up to, right? Because your options are priced off of volatility, and the VIX is the measurement for the SPX volatility, and by extension, the SPY volatility. Okay, so in this scenario, the way that I'm structuring these types of calendars is I want a stable to slightly rising VIX for these types of calendars that we're doing. There are definitely places where you want a low VIX that doesn't move at all for calendars, but in this kind of double version or triple or even quad version, I just want a VIX that's more stable to slightly rising up. Okay. So the first thing I look at is always, where's my VIX doing? And in this case, we're sitting at 21.7, and if you've noticed, and I'll zoom in because I dealt with this all last week, and we'll just go here and maximize this. So sorry for all the wildness on here, but notice went from literally a high of 37 down to 20 in a matter of 5 trading days on the VIX. And because the VIX, the way it works is as it drops and gets lower and lower, the cost of the options gets less and less and less. And you can translate that to in a calendar spread is your profit margin gets sucked out of the trade as the VIX falls out from underneath you. Mm-hmm. So usually not a good idea when you're creating these to make them in a really high VIX environment unless you are betting really heavily directionally on them. Mm-hmm. But in this strategy, this double calendar or triple calendar strategy, we're looking at being non-directional, meaning I don't really have a lean that the market goes one way or another. I just really want it to stay in a range for myself. Okay. So now that we've had the VIX drop out, this is actually an ideal time to start putting them back on. Yep. Hindsight, this was a terrible time to put these back on or put this on, but is what it is. So here we are back at this kind of 20 to 21 range, and this sets up the kind of the first checklist that I'm looking for, which is my VIX, is it roughly in where it's been for the last, say, give or take the last 3 months or so? And is it in the place that typically we have some support, which if you can see, a little bit longer time frame, we have all kinds of times where it's chopped in this 20 to 23, 24 range. And that's a perfect environment for getting enough theta to be in the trade and having it stable enough VIX where you're not dealing with the profit being sucked out because the VIX is falling on you. Right. Then we go look at the SPX, right? Well, in this case, I'm using them on the SPX. We'll look at that. If you're using the SPY, you would use those instead. Mm-hmm. Go here and I say, all right, what is my SPX doing? What are my levels at? So if you have a way that you like to look at your support and resistance, then do that and create those ahead of time so you know kind of roughly what to expect in the trade. On the left-hand side, you're looking at the daily, and I like to use standard deviation channels to give me an idea of roughly where the mean is, in this case, the dashed white line. Mm-hmm. In a very bullish uptrending market, I'm not super worried about, I'm going to pull back to the mean at this point in time. But I do want to know from a perspective of where it's been to give me an idea of kind of what I should expect with the trade. So with the VIX being where it is right now, I'm not super concerned about having this thing go from 3,900 and drop down to, say, 3,800. Mm-hmm. Famous last words, but I'm not really expecting that to happen right this moment. Okay. So what I'm going to do is try to look at bracketing a trade that gives me some spread around what I expect this to move at in the next, say, 2 to 3 weeks. Mm-hmm. That brings us to our next question, which is when you're creating those, how far out do you go, right? And this is a little bit of an art because there is a number of reasons where you can go longer or shorter. I'm going to just stay right in the middle on these and say that for this particular strategy, I'm looking somewhere between days to expiration of, anywhere in that kind of 13 to 20, low 20-ish range. Right. For me on this kind of trade, what I typically find is that I can get enough theta out of that and be in it long enough to hit my profit margins where I'm not sitting there when I'm like 60 or 70 days out. And theta really is taking a long time to populate into my account for bumping my profit up. I've unpacked that. We've looked at roughly where the SPX is doing. The next thing I usually look at is let's look at the options that are rough that far out. Okay, so let's get these out of the way so we see. All right, so our chain that we're looking at then, and I'm just going to put one of them on now. The chain that we're looking at, here we go. Here's the SPX chain, right? We've got 11 to 14 days. That's kind of in that range. I have one on the channel that's 18 to 21, so that'd be somewhere in that range as well. Just going to show you an example where we're in this kind of 11 to 14 days type of range out. Okay, really the reality is the short leg of the calendar, because keep in mind the calendars are created by a short leg and a long combined. They just happen to have different expiration time frames. So if you notice, this position here is the short leg is in the sooner, the closer to expiration trade, and the longer leg is in this, the long leg, which is the longer expiration, is in the 14 days out. So I usually will do that because the SPY or the SPX gives us the opportunity to have a lot more expiration periods to pick from. We get 3 times a week to go from, sometimes more if you have the European AM expiration versions. But sometimes we get more of those pick from. But either way, it's nice to have that kind of Monday to Friday, and there's a reason we do that. Friday to Monday expiration. That's more skew and not having to worry about what that's doing, which again, skew, what that typically does is that's going to go ahead and that's going to price the options for us. So if our skew is against us, that means our front month options, these ones that we're selling, for whatever reason, are worth more than the back month options. Mm-hmm. keep in mind when we are trading them, that shouldn't be the case, because what we're doing is we're paying for the gift of more time when you're doing the further out options, right? So you can get an idea what skew is over here. Right? You go from your option chain and you look to what's the expected move. Okay, so this is telling us that the market makers right now are thinking somewhere around about 96 points plus or minus in the next 11 days is a reasonable expectation. Probably about 70% chance we stay somewhere in that range. And then the same thing on the following week is it's looking at about 107 points, give or take, up and down, about 70% chance we stay in that range. Now, one of the things to notice is that as we look at the percentage here, that's the implied volatility, it's a tiny bit smaller on the back month. And so that would suggest that we have a little bit of skew going against this trade currently, but usually that will work itself out. What you should see is that week over week, you escalate as you get further down, these get bigger and bigger and bigger numbers, okay? Because of course you need to account for the fact that they're going farther and farther and farther out in time, which is obviously more time for you to have that price move for or against you, and thus how they price these things in. Okay. So now that we've kind of knocked out what is our kind of date to expiration we're looking at, we're going to put on one of these trades. I've already done this, but for this example, I'm not going to wait to see the fill, so I just have it in the Analyze tab for us. So we're going to head over there, right? Actually, this is a good example too. Is many people are asking, how do you actually even put them on? Like, how do you even put a simple order in for them? So the reality is it's on ThinkorSwim, it's really simple. You go to the leg you're looking for. Now, again, if I'm just looking at all of this information here, this tells me some valuable info, like implied volatility, what's my probability out of the money, what my deltas and theta are going to be paying me on these or going against me on current volume, open interest, etc. That's information that's helpful to have. However, what in a calendar, and especially when you're doing a double calendar, it's more important to be able to visualize the trade, to be able to see how it works in concert together. Because while it is a separate, there's one calendar and another calendar, and they're two separate trades, but when you combine them, they have a certain type of music they put off together, so to speak, a concert that's being played with them. And you want to make sure it's the music that you're trying to create, right? And so in this case, I put on, here's the one of the legs. So I'm going to show you how you do this. And simply put, and this is not literally how I build them. You can build them differently, however you want to. In this case, how I make this happen is I'm not super concerned about what the current delta is of the actual trade. What I'm more concerned about is the width that I'm getting to open this trade. And so I can't tell, though, by just viewing it through the numbers. Now, right now, it's saying there's a 58% chance that I'll be out of the money. That's ideal for this. On the call side, they're saying I'm a 61% chance I'm out of the money. Deltas are 0.39 versus 0.4, so they're basically neutral to each other. But again, this doesn't super help me see what I'm doing in the trade, so I need to actually get into my Analyze. But the first way you actually literally put the order in, let's say you've done the Analyze, you know exactly what you're going to get, you feel really comfortable what you're going for, and you say, yep, let's go buy this 38.75 put calendar. Okay, so you literally just right click on it. It's going to give you the menu and toss, and you're going to go buy. And I'm going to go to, in this case, because I know what both legs are, I would do a double calendar. And then it'll bring up a menu for me to select the legs that I want for both the call and the put side, or if I'm doing two put sides or two call sides, whatever. It's however you want to do that. If you want to just do a single leg, obviously here's the single calendar that just creates the one put side. If you know for certain, and this is I would say more of the beginner version of making these, if you know for certain what your legs are that you want to use, just open them as a double calendar. It's a little bit easier to manage them that way. When you get more experienced, understand a little bit better how they work and how they move and kind of how the profit margins work on them, then you can do them in a single environment. So think about sometimes, actually Logan, you were talking about this earlier, iron condors. And if you don't know what that is, don't worry. I'm sure at some other point, Logan will have a video on what those are, how to use them. But you can kind of put them on if you break them up. So let's say, for example, you know that you want to be bracketed at 38.75 and 30, whatever, it's 39.25 on the call side. You don't have to buy them at the exact same time. You can wait till the market kind of moves up a little more and then put on that 38.75, so it makes them a little bit cheaper. And then as it drifts back down towards that direction, you can put the call side on, which makes those a little bit cheaper. Again, I wouldn't really monkey with that if I was just learning how to do these. Just do them as a double to start, but that is literally how you can do that. Okay. So on the buy side, again, if you want to just buy the single leg, go here. If you want to do the double version, you just go to double calendar. That will create your order. Right. So we'll just do one now. This creates the order down here. So right now it's telling me, we're confirming this, that my longs, which are always going to be longer dated than my shorts, then I'm going to do a 38.75 call, which we know we don't want to do that. So we need to change that one. Get a 39.25. And then the put we do want at 38.75. And then the simple cheat sheet, when you're doing calendars, your short strikes and long strikes are exactly the same. If you're doing a diagonal, which is like the brother or cousin to the calendar, these are just a little bit different. And we can at a different time get into when to use diagonals versus calendars, because they work and operate very similarly, but there are some interesting and unique things you can do with each of them. With a diagonal, that's a little different than the calendars, but that's a time for different discussion. So you need to make this 39.25 here. And then need to make and this stays at 30.75. So now I've created what I know already is my double calendar, and then I just, of course, hit confirm and send, and it will start working the order as a whole together. Okay, so there's the price I'm going to pay for this. It is a debit. However, most people, when they first get involved with looking at, say, a calendar on itself, or a diagonal on itself, or even doubles or triple versions of them, the idea that they're paying $7.90 for a debit, and they have probably experienced buying long calls, and they're like, man, I don't want to risk losing $7.90 on this. You aren't going to risk losing $7.90 on this. I mean, sure, that's possible, but these are designed to be able to manage them and be able to adjust and defend if necessary. Taking a full loss on these, it's actually kind of work to do. You have to personally put your head in the ground and pretend like you never put the trade on to even potentially have that happen to you. And because you're smart traders and you're building your tool bag up of how to, be in this for the long term, you aren't going to do that. You're not going to take your, put a trade on and forget you've done it because it's just silly. Why would you waste money like that?
Yeah.
Okay. So anyway, hit your confirm and send, and then that will go ahead and start working the order. And eventually the market maker will say, yep, great deal. I'll give you this, and you're populating your trade. So the other thing that you should always, always, always do, especially if you're a ThinkorSwim user, is you need to get these into the Analyze tab. It's a million times easier to manage them through the Analyze tab than trying to do this by just looking at the legs. It's very confusing when you have multiples going on at the same time, especially if they have similar strikes but different expiration dates. It can be really confusing and really easy to accidentally add or close the wrong legs of the wrong calendars, or a diagonal if that's what you're doing. So I always you just right click anywhere on this order bar and go to Analyze Trade. Okay? And then that's going to bring it immediately into actually visualize the trade. Now, of course, you being an awesome trader now, you wouldn't actually even send the order in until you could actually see it, right? So that's what we normally do, and then we do the actual sending from the Analyze section. So I'm going to get over to Analyze here. So here's the exact order. So this is what it looks like currently. It's very well centered, and we can get into a second about kind of why I set it up this way. But so there it is as a whole. This is the two calendars together, but I always think it makes a good point when you do them separately at a time. So let's just take and put our call side on first, right? So here's our call calendar, and as this price drifts further and further and further towards the middle peak here, the short leg, this becomes more and more and more valuable. As you get closer and closer to expiration, that's what will happen. Now, because I don't know exactly which way the direction of the market's going to go, and because the VIX, we've checked this already, is in a place that I think it's a slow grind one way or another, I'm going to put another one on, right? So now I have the put side on. So we take the calls, now we do the puts, right? Now we have our little kind of mountain peak here, or our tent, our single post tent, and then we'll make money as it works its way down, 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 okay? So, however, in this scenario, because we have two of them, it looks like this, right? Here's our trade. So when we talk about what we want it to look like, you want your calendars to look like this. Now, the spread that I'm working with, remember, what did we think? We saw that it was roughly about 90 points. That was the spread by which the market was expected to move from now until next week, Friday. So that, how much am I covered underneath this? Right now I'm covered from 38 roughly 40, we'll say that 38.40, all the way up to about 39.55 or so. Okay, so if we do our math correct on this, that gives me more than 100 points. I'm giving it a couple extra points on both ends to allow that trade to move back and forth inside of it. Okay, so we can, depending on when this takes place, but you can let the trade, drift this way, drift back this way, drift back this way. But as long as we stay somewhere inside of this body of the trade here, assuming that our VIX doesn't fall off from underneath us again, you will make money in the trade. It'll be a rather painless, stressless type of trade. Okay. So I like these because I don't want to have to, when I'm working on my weekly incomes, I don't want to nonstop watch the market and be on the nonstop, like, oh, I got to add this on, I got to adjust this, and oh my God, I went up a tick here and there. For the most part, these types of trades, they're slow moving, and you're just essentially trying to allow Theta to keep building and working for you. Okay, so now that we've made the pattern here that I'm looking for, now we go look at the guts of the trade. So again, a question that's usually asked is, what kind of deltas are you looking for on this? So from the individual leg side, that's less important than it is as the trade as a whole looks. Okay, so when I look at these, what I want to be is direction neutral. And sometimes I'll make them where I have a slight tilt one way or another, but the delta right now of about 1 is pretty dang neutral. Obviously 0 is this trade makes no difference whether it goes up or down.
Right.
Okay, so kind of 1.6. So what that's telling us is that a fractional element of the trade will do a little tiny bit better as price drifts this direction. Okay. So when you're looking at it from a delta and you want it to be truly non-directional, you need to make sure that your deltas are around 0 or as close as you can get them to 1, 2, 3, something like that. Okay. Now, just for those who aren't aware of this, if your deltas are negative, then that means that we have a slight bias that as it moves back towards this way, goes back towards the put short leg, you'll have a little bit better profit margin going that way. Okay. In this case, I just tried to make it as neutral as I could. And we saw initially that it was basically a 0.4 or a 40 delta on both ends. Sometimes you can get more, it just depends on the environment you're in. And really, again, what we'll come back to is, what is the VIX doing? Is the VIX giving me the opportunity for this, for wider, or is it just right now, this is what it is? I can't say for certain that every single time I'm looking at 40 deltas on both sides of it, because that definitely isn't the case. Sometimes it works and sometimes it doesn't work like that. So we're talking kind of through, again, taking a quick checklist on this from how do we create them, right? We want to start with our VIX first. And we want to take a look at what the underlying is doing, in this case, the SPY or SPX. And for this example, the next thing we look at is, do we have a bias of what we believe this thing's going to move directionally? Do we think it's going to move big time up or big time down? And if so, you can structure this so that the trade can accommodate that. Okay, so if you had, some system that you use or some set of indicators that were, that you felt very comfortable with, you've documented how they work and you feel really good about how they move, and when they're in certain positions, it gives you a high probability of a direction one way or another. Well, then of course you can set this up in such a way to take advantage of that. So let's just say, and I'll just move this around, let's just say that we were 100% convinced. We had our crystal ball was telling us that, and the market was right here, right? And we had no calendars on at this point in time. And you were saying to yourself, the market's right here, it's at 39.25, but all the different things I use, I'm absolutely convinced 39.30 is going to be resistance. It's going to knock the market back to somewhere around 3,900 to 3,880. And I want to take maximum profit potential out of that. Well, you then set your calendars up in such a way that they are going to come more in the money as it falls back down, right? So I'm starting the trade with it more towards the front, and then I end, would otherwise if I was doing it towards the back. So I'm starting more towards the back. I want to give it room to work up, right? If I was really like, I had something else telling me that this is going to be very bullish, put it in front of the price so it can move into my profit margins. Okay? So you do have you don't have to just be purely, delta neutral. You can be, notice this with delta here. Now the delta is 29.3. So now I'm very delta. I'm going directionally up. Here's what I want it to do. Okay? So you have the ability to adjust and tinker this around with whatever makes sense for what your own analysis is telling you. which gives you a lot more versatility of, if you're really, really heavy bullish in the market, make some calendars that are out of the money or right at the beginning of the money, or at the money rather, and it can lean and work its way into it. And you make your profit increases. So not only do you have theta going for you at that time, you also have, because you're going directionally in the right direction you're trying to go, you'll see the profit increase from year two, which is the sweet thing to see.
Heck yeah.
So anyway, but we're going very direction neutral in this particular trade. Cash allocation is another good question that's been asked, is roughly how much are you putting in to this kind of trade, for this type of setup? So this is obviously very dependent on your account size, dependent on what your objectives are, and everybody needs to be responsible for their own objectives and risks and those kinds of things, right? But in this scenario, a rule of thumb for this type of income trading account is I will go as much to about 50% of whatever my account balance is into a particular trade or a particular set of trades. Okay. So in the, say, spread world here, let's just say we had 100 grand in your account, then I would be comfortable putting roughly 50,000 into one single version of this trade. Okay. So maybe I'm thinking, and again, you always size up and size down based on what your advantages are. So if the probabilities, and that's what we work off of in options trading, is what are our probabilities for success? The probabilities are really high and they're in my favor, then size up. Learn to size up properly and go into trades with confidence, because of course, yet again, being an awesome trader that you've become, you have done your work, you've looked at, you've documented, and you know how your setups play out. So when you see the ideal version of that setup happening, size up into it, right? Take advantage of that. Right? The other thing is that calendars are going to be really forgiving for putting a lot of money into them. They have a flexibility to them that a lot of other trades don't, which we'll get into how you defend some of these things. But they have a flexibility to them that make them very accommodating to make adjustments on the fly based on what your calendar is doing, the underlying price is doing for you. Again, but from a cash allocation, I usually put about 50, max 50% when I have a really high setup. Typically, I'm looking more at like 20 to 30% in there. And actually have a couple going at the same time, so the account will get to roughly 50% filled at any given time with calendars. And then I always reserve about another 25% to make any kind of adjustments that need to be made on it. In fact, I don't think I've ever had this happen where I had to put the other remaining element of the capital into the trade to try to adjust or save it or something along those lines. Perfect. 25% is way more than enough. And then again, the rest of my account I always have, and this one is always 25% is in cash. Rarely ever am I, sitting at 5% cash and I'm just invested into a million things at the same time. I always want to have cash at hand for whatever might come up and then I need to take advantage of it. Always. So from a cash allocation perspective, that's how I would tackle this. Is good rule of thumb is about 20 to 30%. You have a really good probability setup, go up to 50%. Always leave 25% for protection. And then again, for me, I always have at least another 25% that's just sitting in the sidelines just based on whatever might happen.
The quick question that I had that I wanted to touch on, because I know we're talking about cash allocation and stuff, but let's say you were in with 50 grand, and you entered this trade around 2 p.m. on a Friday, and what would you expect the theta to decay that by Monday morning, I guess? So like if you were then to close the position, if you were in with 50 grand on, let's say this specific trade.
Yeah, so actually we can probably just build one and I'll show you what it looks like.
Yeah, that'd be awesome.
Actually, what we'll do is we'll get a visual of that, but let's say you put in, let's see if we can zoom in here. We'll just zoom in on this. Let's assume the VIX stays around 21.
Yep.
For the remainder of the time here, I'm going to zoom this into what your theta would be paying on the 12th, right? So let's say you put one on that was going from the 12th or going from expires on Monday. So your expiration is Monday, Wednesday, or you set a single calendar on that's Monday, Wednesday. So this is assuming Friday, right? The 12th or 2/12. Yeah, it's Friday. So your theta at this time with this vol environment would pay you 585 on Saturday and 582 or whatever's bouncing around right now on Sunday. So theoretically, if you wake up on Monday and it stays in between your width here, that should account for an additional roughly $1,000 in your account.
Fantastic.
On that Monday.
And you put up.
So we get to we don't lose money by sitting in the trade. We get paid money to sit in the trade.
And you put up 7,600 roughly.
Yeah, this trade cost. Yep. So it was about 70. This is a little over 7,900 for this trade.
Perfect.
Correct.
Yeah, that is fantastic. That return is fantastic.
Yeah, and that's a killer return, right? And that's something you can, again, when you get these string together and you get comfortable, and consistent with knowing what they're going to do and how they're going to act.
Yeah.
You can have one of these expiring every single week. You can have, essentially, I mean, it's going to take a couple weeks to get it going that way, but you can really have one going every single week. Again, assuming the VIX stays where it is. And just literally keep going over one, week after week after week after week. And that's making some serious income. Again, my profit margins I look for this is I'm happy if I get about 15 to 20%. If that happens right away, I usually will close these out. The only time I wouldn't do that is, again, I'm looking at where my market is moving around. And if I have a high probability reason to believe that the market's going to pull back, and I'm saying, around this area here, and it's going to pull back the day before expiration, I have no problem hanging on, longer in the trade, because remember, as we pull back and the market goes backwards on us, we have a lot of runway to work with here. Plus, the cost of the options gets more expensive as the VIX goes up, right? Because volatility going up creates more value, more cost in the underlying options, which then, of course, bumps up our theta. And because we are getting paid to be in the trade versus we are paying to be in the trade because we don't have a negative theta here, that is to our advantage, is to take advantage of that. Again, the perfect scenarios for these when you get these max profits, because again, you can see what your potential, your theoretical max profit is at the top of the peaks here, right? And again, we did this in the last one, but if you look over, I mean, 15,000 is what theoretical max profit is on a $7,900 trade. So for a weekly income making 100+% for you is that's not a bad deal.
That's incredible.
And the same thing over here, right? I mean, the front one, the call side is going to be just a little bit south, maybe 13,500 is roughly what you would expect from that. But again, I mean, I'm looking at this saying, if the scenarios line up and I have a really good, means for finding resistance or I see a lot of momentum coming out of the market or something along those lines, and I'm further up in the trade, I'm sitting somewhere, around that front call strikes, the short strikes here, I'm absolutely going to consider hanging out of this to see if it pulls back. And if it does pull back, it will beef up the volatility, the actual theta force. You can actually, I can adjust the volatility, and let's say we made it up, it went up 5%, from now to then, you'll watch your theta bump up significantly because your volatility is being pushed up, right? So again, a good visual on this always is, volatility. What it does to these kinds of trades is, if volatility stays sideways, you're gonna have a normal T+1 line, this pink line, which represents really how much theta you're getting. If volatility spikes up, it blows up this line for you, and it pushes this up higher. And the higher this pink line gets, the more profit you're getting pushed into your trade. And vice versa, it does the opposite. If volatility drops dramatically, it will pull this trade, all your theta out of it. Okay, so again, really not a good idea to put these on with dramatically dropping theta, or dramatically dropping VIX on you. It's going to crush your profits. But in this scenario, we want to understand how these work. Is VIX works for you if it's going sideways to up, works against you if it's going down dramatically. It's okay if it drops slowly, but if it drops pretty quickly, like we did last week, you're going to struggle to make a profit on this. But again, we don't normally have it drop 40% a week, so that's not normal.
Correct.
So let's see what else. So defending, that's always a good question. Is how do you defend these things?
It's a great one.
What are the action points, right, that you're looking for? And I think for anybody who's trading, right, knowing your expectations on this is always going to be super important for what you should do. Oh, I'm sorry. Here it is, right there. All right. So let's just show right now. Let's just say volatility pops on us. All right. So I'm going to let's make it say it goes up 10%. And what you'll see is once that does that, let's go ahead and start that plus 10%, and just notice how much we jumped up in theta here.
Oh, yeah.
Right, so we went from 300 something to being paid 625 a day to be in the trade. All right. Notice what our pink line did. It exploded up when that happened.
Yeah.
Okay, so again, Theta pumps up the trade. Also made our max profit go up to $40,000 on a $7,900 trade.
Jeez.
So volatility really works in your favor when it gets pumped into this thing.
Yeah.
Conversely, let's make it negative here and see what happens there. And this is what happens when volatility gets sucked out of the trade. Now, this is a little bit wonky because it's not counting any of the Theta for all the time you would be in this, but just know, you can see how badly this pulled all your profit out of here.
Yeah.
It's way upside down. Again, this is a really odd way of showing it. You'd have to go towards expiration to have it be more accurate, but still, this would be assuming the worst case scenario is that you got in and literally the moment after you jumped into the trade, it dropped 10%, which is highly unlikely that ever is going to happen to you.
Yeah.
So there you go. That's what volatility does to one of these trades. It dramatically will change this graph and just absolutely crush your profit margins if that is the case. Yeah. So again, rarely ever do we have that kind of jump one way or another on the VIX.
Yep.
But again, if it does, know the expectations of what you expect to happen. So defending, let's do some defending. I'll actually do this sort of real time here. We'll put these trades on and see kind of what happens here and how we actually look at them. So currently, here's where we are. Right, this is what it looks like. And here's a general rule of thumb. Again, every trader has their own view, and that's kind of the beautiful thing about trading is that you can have collections of thousands and thousands of people who have differing opinions on what they think is going to happen. Mm-hmm. But either way, you've decided what you're going to do, and you've determined that for you, defending these things is once you get past your short strikes, you need to do something with this. Okay, so we'll just say on this end, on this side of it, we'll worry about the top end because that's usually more of a problem as you go through the top end of these than the bottom end of it. But let's say we find our price sitting somewhere around here. Okay, so defending these, what my risk, of course, is that if I don't do anything and the market continues to put pressure on the trade by moving this way, right? You can see where my losses are. They start getting pretty big. Mm-hmm. Do something. So as a rule of thumb, usually when you're in same thing for a single calendar, if you're in a single calendar or a double calendar, then I'm going to look at an action point somewhere between here and here. There's some kind of, I should do something on this, right? Obviously, I'm factoring in a couple of things, such as where is the current market on the playing field? Do I see any other, is there some sort of other news-driven something that's going on? Is our Fed chairman going to speak? I mean, things that might move the market short-term will help you dictate when you're doing something or not. Mm-hmm. But either way, that's roughly where these action points are, is somewhere in this neighborhood where I should do something, especially if I have plenty of time in the trade. But somewhere in there is where I need to do something. Okay? Obviously, one of the biggest elements that we face with trading is the element of time. And if you don't have enough time to defend, you should probably close the trade and move on. Mm-hmm. However, with these, we give ourselves time, right? At least, earliest we're doing it's around 13, 14 days out, the earliest or the soonest. But we have time to defend them. So we can always just add another one in. So in this particular example, we're looking at this counter. I'm saying, all right, my risk is that I'm going to just keep flying this direction, up at the top there. I need to make sure that I'm at least accounting for that because I don't want to get to this losing point where I'm at 39.55. So I want to keep the integrity of the shape of this trade. What does it look like for me just to add another one on here and make a triple version of this? Mm-hmm. I would just head on over to my trade tab, right? Go into the same exact expiration period, right? And I'm going to look at going in the calls because I'm above current price. And the SPX, it doesn't matter. You can do calls or push, just whichever one are cheaper. And because it can't be assigned in the SPX, there is actual no underlying you can actually own. So let's just say we're looking at 39.55 initially. We'll just start there. Now, before I go and buy it, what do we always do, right? We got to analyze a trade on this thing. So let's go to our calendar. Let's get the order showing up here. Okay. And then I don't know how this affects the trade by just looking at it this way. I have to see it in my analyze. So I'm going to right click anywhere on the trade, bring up analyze trade, and now we're going to see how it works together in concert. So scroll on here. I'm going to turn this off. So let's just say right now we're looking at 39.55. I want to pay attention to what the sag looks like in the middle because this is a risk point if you're sitting right here and the market just doesn't do anything or you have a lot of volatility drop out. This will get really saggy all the way near to the 0 point. So I'm going to add this on, and does this give me enough width to make me feel good, right? That I feel like I'm covering enough. I'm probably going to add a little bit further out on this. I'm maybe look at 39.60. Mm-hmm. This pushes my risk now back to 39.80 range. So again, you'd look at your levels and you say, okay, on the SPX, the SPY, do I think 398 or 39.80? What does that level look like? Is there lots of resistance there? Is there no resistance there? Is there any extensions there? You do all the factors that you look at. Is my RSI in the nosebleed section if we get up to there? Is my stochastics coming out? Whatever you're looking at, but you find some way to measure, roughly where you think that market's going to move up to, and then pause maybe, hopefully, for a second. Mm-hmm. I'm probably going to take this and maybe shift it a little bit further up. So we're at 60. Yeah, see, that looks a little bit cleaner to me. So I'm probably going to leave. I'd probably look at this as being a defending play that still gives me room up to 39.82 or so. Mm-hmm. You go too far out. Let's say we go 39.70. So notice how you've made the potential for some sag to show up in here. Yeah. And it's really going to give you a whole lot more room to deal with. You got another couple of points, but now you've added this element of if volatility drops, this thing is going to drop pretty fast. It is a little too much sag for my personal like here. Yeah. So probably 39.65 to 39.60. Oops, price is going all wonky. Let me check that. To 39.60-ish. Somewhere in this neighborhood is what we're going to look at for the actual price. This is not accurate on the cost. This is now $10.45 to get it here. I'm not certain why it's showing goofy prices, but either way, we are looking at this to give us roughly the same kind of width here. Somehow I magically just popped up $1,400 in profit. That's great. So yeah, here it is. It makes a little more sense. We'll let this thing catch up in a second. I think our toss is moving very slowly. Okay. But again, assume we had moved over here. You want this shape to be, maintain a kind of some integrity of not having all the sag. What happened? Why did I push that lost its mind here? I don't know. Either way, so here we are looking at this. Oh, that's why this date got changed. Oh, you know why? So here's something else to know. When you get further enough out, it's not some of the option legs aren't supported. So 39.75 must not be supported in this 22nd of February leg. So if you were to go look at the individual legs, it's probably not supported in there. So, but from an integrity standpoint, yeah, I think I'd probably look at 39.60 or 65, maybe 39.70. No, it's too far out. So I would stick to 39.60 on this one. Gives me some room all the way to 39.80-ish to worry about. And again, what's my next action point is if we move price up to around here again, right? Anywhere roughly in this ballpark is all right. So this is the interesting part when you with how you can keep piecing these things together is you have lots of options still to work with, especially if you have time left. So let's say all this happened with still 10 to 12 days to expiration going on. Well, I have three options I can do here. I can say, all right, I've had enough to do with this trade. I'm at a scratch now at 222, 210-ish. I'm going to close this out. Or if I still feel like I like the theta I'm getting, I still think that I'm, right now, bad negative delta going on. So what else do I want to do with this thing? Well, what I could do is say, all right, let's take the lower end off because he's not doing anything now. He's just basically a weight on my trade. I'm going to remove him off of here. Okay, balance my trade out a little more. And I'm going to add him back onto this end. I'm just going to make another one up here. Okay, and I'm going to recenter this trade because I got plenty of time to work with. So let's just say we did that. Let's say we'll take this 38.75 and we're going to move him. So we'll move him to the front and we'll take him from the bottom and put him to the front. And let's look at maybe 39.80 to start. We'll make him a call as well. So maybe it looks like, nope, get a little more width. It's not far enough out. 39.90. Okay. So I would look at something like this as a potential adjustment to this trade. And let's check the price off here. There we go. That looks more appropriate. So for a $1.85 debit, I can get a little more protection. And now I've just basically recentered the trade, right? So now I'm giving myself from 38.90 to 3,900 all the way to 4,000. And that's just by moving some things around on the trade. And again, you give yourself, that's the beauty of these styles of trading is that you're never out of a trade in terms of adjusting and doing what you need to do if you need to protect it. You have the opportunity to move them around. So you can, take one end and put it on the other end. Again, you use your your own analysis to decide when that makes sense in terms of a price movement perspective. So if you have something you use to help you guide your directions of what the underlyings are doing, that becomes really helpful in how you want to create these. Because you also may find that, you know what, I know that I have stiff resistance here at this level, and I'm not going to add on protection at the upper end because I don't think I'm going to actually be able to use it. So I would just leave it off and let this trade drift itself back towards the middle, and that's going to be a nice profitable trade overall.
Yeah, that's fantastic.
Okay? So that's kind of defending 101. There's some unique other things you can do depending on what's happening with volatility. But if volatility stays pretty neutral on you to sideways, you really will have a hard time not making money with these. You know, in fact, you'd have to kind of work. You'd have to put them in really goofy, like super wide spread so that your kind of tent shape or your mountain shape here is really sagging in the middle. Mm-hmm. That's really the only way that I can see that you would find yourself in a VIX that doesn't really move around environment where you're not making some kind of money on this thing. And again, usually they're pretty painless. Usually they don't have a whole lot of tweaking and adjustments you have to do on them. Again, that's really just driven by what the VIX does. So, and to an extent, your underlying, of course. What other questions might you have, Logan, or what else things I may haven't covered in this that might be of value to touch on here?
I think everything that you touched so far, I think everything else we could save for another video and get even more in depth on, like you said, in the last video, there's certain topics where you're like, oh, we could do a whole video, or a whole hour-long specific video.
Sure.
And we can always save those for the next one. But I think as far as answering everybody's questions in the comments as of right now. All right, well, thanks, Halcyon, again for being on this video. And I know that I understand this way more now, even just looking at the visual, like you said with the Analyze tab. And I'm super excited. I mean, even just throwing, like you said, a $700 debit up roughly, and this is just an example, and collecting a really nice theta over the weekend, and potentially pulling out like 60 to $100, right? And then closing that position.
Yeah.
You're looking, like you said, 10, 15, 20%, 25% return, and then hopping out of that position. That's something that I want to scale up to, and eventually go in with maybe $2 to $3 grand per play, and then try to squeeze a couple hundred out of a position. I think it'd be really cool.
Yeah, and it's completely and totally doable. Like I said, you get a pretty stable VIX environment, and you should be able to do that regularly. In fact, like I said, it would be, you'd almost have to purposely set things incorrectly to not make money on them. Just put your head in the sand and not pay attention to what's going on at all. Because they do give you lots of options and flexibility to make tweaks if you need to.
Yeah, that's perfect. I really enjoy this strategy, man. I appreciate you coming on another video. And, if you guys have any more questions, please leave them below. Halcyon's one of our premium traders. He's been helping out for the last couple weeks, so it's been great to have him on and share his strategies and his plays. So I really appreciate you coming back on, man, and we'll have to do another video probably next week on any more questions that we get, and then we can get more in depth.
Absolutely. Let's do it.
Specific things that you want to. Yeah, that'd be fantastic. So yeah, I appreciate you coming on.
No problem. Thank you.
Yep. All right. So guys, make sure you leave a like, subscribe on this video, comment below anything you guys want to see, and we will see you guys in our next video.